See energy sector, XLE. It's been straight up. Today, well, it was one of the worst performing sectors, but you can barely notice it, right? As it's pulling down, it's still even tagged its lower weekly implied move. Look at material sector over here. Also been on a monster run to the upside, breaking through expected moves. And today we came into its lower weekly implied move. Surprise, surprise. Consumer staples also has been on a monster tear up. And today, many stocks were actually getting hit in the consumer staple sector, but consumer staples by itself was right down there at its lower weekly implied move. Take a look at the daily implied move. Yes, these are actually part of the Discord. Now I start to give you for a Thinkorswim platform. You can get our daily implied moves on your chart. And same with TradingView. We built out that script. It's good to go. Today we hit that lower implied move on Qs, bounced from that level. IWM, same exact thing. So it played well within that kind of parameter of risk that the market implied. In fact, when it comes to expected moves, if you don't use them by now, or if it's your brand new first time to this show and you don't know what expected moves are, I have a separate video on that. But you are absolutely, utterly flying around with a blindfold on, because these expected moves is what the options market is actually pricing in forward-looking risk. It's incredibly important. It's not about, hey, it bounces at this level. It's more about, hey, is the market outside of what it expected? If so, what can happen, right? I know what can happen. We'll talk about that on another show. Here's PepsiCo. PepsiCo came down to that lower weekly implied move, creating opportunities, right? If we were waiting, if we missed the move and we're starting to look for pullbacks, well, now you're at a lower weekly implied move on day one of the week. Perhaps now you can start initiating into these and top. Remember, strong stocks typically get stronger. That's one of the basic principles of technical analysis. We have higher lows. Obviously, we ripped up higher, good earnings report, and now it's pulling back a little bit. Same thing with Hershey, right? Hershey I was looking at over here, and I was able to make it into a position before earnings came. Bullish earnings expected move, or earnings move, power earnings gap, they call these. Bam, we followed through. I was already in the name, and I started to sell off a little bit of the position, and I've been looking to get back in. Well, today, as we hit a multiple standard deviation move to the downside, I was aware that we're getting outside of weekly expectations, so I was able to add a little back into the position on a pullback in an overall uptrend. That's what I do. Now, overall, this market's been a little 50-50, right? It's a rotation game. As things have been selling off, people start to rotate. Companies, hedge funds, institution, whatever you want to call it, retail. It's just in and out of various positions. There has been no really full-blown 90 stocks, 95 stocks selling off, full-on capitulation at this current moment, right? As the market's really kind of just been going sideways. If you take a look over here, one of the worst performing stocks in the S&P 100, I believe that right there was Intuit, yes, and this one actually didn't even come to its lower implied move. So software stocks, ain't nobody rotating into software stocks, at least right now. You can take a look at IGV. It's trying to find some sort of a bottom, but overall, it ain't looking all too hot. And this is where that interesting chart kind of came in. How can we take advantage of this correlation? This is a chart of IGV in purple, which is the software ETF. Orange is Bitcoin. I saw this chart floating around Twitter space by 3 million people. And I was like, yeah, that's kind of cool. Let's look up the correlation between the two. Right now, it's actually at darn near 1-for-1 correlation, meaning that they are moving on a 20-day correlation almost in lockstep fashion. Now, for us, for those that have been around, already know that I have a tool to help navigate the price of Bitcoin. We call that tool the Sailor to Shift tool. This was created by me a while ago. And when you start to see the 4-week rate of change between Bitcoin and gold go slip into negative territory on a weekly closing basis, that is your sell signal. So we had an official sell signal from this week over here. And then when you start to cross below that weekly low, you get your official trigger. So from this point right here, we have been on a sell signal, sell trigger, and we have not seen a buy signal, buy trigger yet. We got close, but no cigar. And from that point, we have sold off from 110-ish down here to 65, being below about 60K, and it's been going off. Now, recently, we saw a little bit of an uptick, and I want to remind people that may have not have seen this. This is all the signals. There's a couple of no triggers in here, but these are the official triggers. You can see the green line was right here. We started shooting up like a rocket ship. It held it the entire time, and then the red line was the sell side. This doesn't look like much, but that was 60K down to and around, what is that, 30K, so a 50% drawdown. It caught this. It sold this. This protected you from this sell-off, It caught this run up, caught this run up, caught that run up, this run up, and then it's been protecting you from this one right over here. So what am I trying to tell you? I'm trying to tell you that if you are looking to play some fade trades with software and even crypto, yeah, when we get extended readings on this, it creates opportunities. But if we start getting a buy signal, buy trigger on this, perhaps we might even want to take a look into software names, because perhaps that might lead to something bigger that we've seen like in the past. Now, it could just be a whipsaw signal. We don't know when that's going to take place, but it should at least be on your radar given the strong correlation between these two assets. You can take a look at crypto right now. It doesn't look good, right? We broke down from this sideways price action. We broke down from this range. We're below a declining 200-day moving average. If you put the relative performance to the S&P 500, it's been in a steady decline. It's below a declining 50 EMA. I mean, it looks like it's just consolidating here to break down further. Okay, but that doesn't mean that it can't potentially change. There are catalyst that can occur for people to flow back into these type of things. And that's why we're going to be watching this. Well, I'm going to be watching it a lot closer, and I'll be notifying you when this changes. I'll notify it in the Discord. I'll notify it here on a video. So be sure to subscribe if you like this type of content. If you take a look at gold, right? Gold was down on the trading session today. Bitcoin, right, was down overall, but you can see between these two assets, it did create a rate of change pop up over here. So we'll ultimately see what that looks like this week, next week, the following week, and so forth. Okay, let's take a look at market conditions, because market conditions are important to kind of keep an eye on. And as you can see, at this current moment, we are below that gamma flip line, which changes the way we approach the market, changes the way that I approach the market, right? When you're below the gamma flip line, let's keep it very simple here, the dynamics of the markets change. You'll get dealers that sell into the selling and they'll buy into the buying, which means volatility typically increases. And we've shown some great visuals on how that is. And if you go to my X page, you'll see a lot of articles and some particular that I wrote specifically on this topic of market conditions changing. When you're in positive gamma, this is what I like to call a more swing trading environment, where you play breakouts and then you'll get the dealers to buy the dips, sell the rips. It's cleaner, it's less noisy. And well, as you know, it's been very noisy as we've been in and out of positive and negative gamma, neutral gamma, and so forth. So when we're in negative gamma, how do I approach the markets if breakout trading isn't working as clear? I start to look at dramatic moves and look to fade them for smaller bounces. I do smaller positions. I'm typically faster to get in and faster to get out of those positions. And I just try to, pick up some here and there trades that make sense to do so. For example, look at some of these larger cap names, right? If we're going to get rotations back into tech, maybe we should keep an eye on some of the tech names that have been selling off, but have been going down pretty much in a straight line. So for example, Meta, right, broke its weekly expected move a couple weeks ago. We came into it this last prior week, and today it's a shortened trading week and we're right there at about break even as we put in a lower wick. So if we start breaking above the high over here, would that mean that the stock is going to all-time highs or everything's fixed if we just pop up to the upper weekly implied move at around 665-ish? No, but are there opportunities in there? Absolutely. And we've been selling off hard. So yeah, sometimes we bounce from those type of levels. Take a look at Amazon. Amazon got cracked on earnings and it's been selling off over here, creating another lower low. Today we had a bullish outside trading session. All right. So this got on the radar. If you're in the Discord, these are some of the names that I actually mentioned in the trade ideas section. So perhaps we get a little rotate. Now, if we bounce up to the upper weekly implied move at 206 from where we are, like 201, does that mean everything's solved for and fixed? No, but there's still opportunities being able to do this, right? We might not come up here. It might just drop significantly down. I don't know, but that's how I approach the markets when we are in negative gamma. I look for the potential of rotations after strong sell side activity. I mean, if you want to get crazier, you can look at something like Snapchat. Snapchat's been actually just absolutely broken over here, breaking expected moves, horrible earnings, continue to follow to the downside. It's trading under $5. But yeah, this will eventually have a bounce. The last time it kind of had a bounce was way over here, bounced up a little bit. I guess maybe that was a bounce, not really. But yeah, this is a straight line down. So if we get underneath this 450, right, 448, 450, which is the lower weekly implied move, it's right around those areas. Yeah, perhaps that can create an opportunity to see a bounce, or maybe prior, right? If we break above today's high, it pops us up to around 518. There's little opportunities. I don't really like to trade these lower price names, but seeing Snapchat under $5, and it was a strong move basically from here to here, being part of a bounce back up, right, could be well worth it. Just has to be smaller amounts. You can't go too heavy on these names. If we continue on, as I've already stated, we are below that negative gamma flip line. As far as the weekly implied move for the SPX goes, we do have up here at 69.78. That's for this trading week. And the lower implied move on the week is at 66.93. Our lower daily implied move for tomorrow's trading session, we're pricing in about 6788. And above us, 6897, which would put us right near that current gamma flip line. If you take a look overall at the VIX futures curve, yes, the front month right over here is above 20. So yeah, we're getting some choppy action in the markets. But are we in backwardation? The answer is no. So we're still pricing more volatility out into the future. Typical, right? It gets a little bit more crazy in the markets if the curve looks like such, and we're not there yet. If we take a look at back month, first front month volatility, kind of in no man's land here. I would say if we get down to 1.0, I'd be more interested in looking for the market to start to bounce from those levels. Just like when we got way over here, we started to say this is where markets can start to consolidate and or pull back, and that is what has been happening right now. If we take a look at SPY on the 15-minute time frame, this is a little bit more tactical time frame over here. There is something that I want to call out, and that is that bears have the opportunity to really kind of bite in and around these levels. What do I mean by that? Well, as you can see, we're below a lot of these lines. What are all these lines? Let me walk you through them. The purple line is just the moving average, right? I don't really trade based off of the line, but it helps me determine shorter term trends. That's the 5-day moving average. What's it doing? It's declining, telling us that the shorter term trend is currently down, meaning that if you want to be patient and you want to trade with the trend, it'd be smart to have this shorter term trend get back onto your side, meaning that price gets above it, it starts to flatten out and starts to turn up. This, if it starts going down, if it starts knocking down, you'll look back at this and be like, wow, if I just watched the 5-day moving average and just stayed away when it's declining, I could have saved myself all this trouble. That happens all the time, but people ignore it. Whatever. This gray line over here is last year's closing price. Where are we? We're slightly above it. What's that mean? We're flat on the year. People, it's the middle of February. We haven't gone anywhere yet. Okay. What are these other anchored volume weighted average prices? We have a blue line, that's month to date. We have a green line, that is the year to date low. The red line is the year to date high. And then that gray line right up there, hiding between the daily implied zone over there, is the year to date anchored volume weighted average price. So what do we have here? We have areas of confluence, meaning that if price action goes kaboom tomorrow, watch all these areas in here that are in confluence with the upper daily implied move, because price can easily get rejected and pulled back as these are starting to decline. It would be a whole heck of a lot better if we came in, did something like this, and then started breaking through those levels, and then they started to turn back up. It's going to take time to heal this, or it's going to take a catalyst to explode through it. If we start to break down from these levels, head higher, start to pull down, maybe back into the week to date, it does something like this and then breaks down to this, watch the lower daily implied move, because that can act as the stopping ground where we start to kind of just doodle in and around for an entire trading session. If we break through these levels and get continued negative flow, you pay attention to the lower monthly implied move. It's only February 17th. We still got some time left. And the lower weekly implied move for the SPY. If you want these levels, I post them once again in the Discord. You can put them on your charts via Thinkorswim or TradingView automatically just by copying and pasting the script stuff. And or you can use your own platform and you can just look at the levels and draw them on your charts, whatever works, right? I want to close off with just a couple of charts here, a couple of things. Really, this is the last chart, but then a few other key points as far as catalyst goes. We did officially hit a lower low. So as you can see, we had a lower high and now we have an official lower low, meaning the trend has shifted to more bearish. Now, overall, we're flat on the year. And I want to call something out that's, if you're just looking at the price action as it stands right now via candlesticks, you will see the lower low. But I want to be very clear. If you are looking at a line chart where you're just looking at the closing value, we have not gotten a lower low. And a lot of the times, especially professionals, they pay more attention to the closing price than anything. So if you do that, I want to just be clear that you had a close here and your next lowest close was right over here, meaning that we actually still have a higher low if you look at it in terms of that, okay? So in my, thought here would be, if you're an amateur and you're looking at this, say, oh, it's a lower low, we're going to trend down, even if it bounces up. Yes, you might be right, and then whatever. However, a very painful trade at this point would be saying we have a lower low, we have a lower high, we're going lower. So the pain trade here would be like not noticing that, hey, the close is actually higher. And if this thing starts to scream up higher, there's going to be a lot of people that would miss on that trade. And that right there can turn into itself a painful trade. And, ultimately overall, what we've been talking about is the potential for a big, beautiful bull trap. And it could very well be setting it by this small undercut and still leaving a higher low via the closing price. It's too early to tell. And that's a lot of narrative. So we got to see how price confirms it.
This red box. And so the retracement from that zone is 76, basically. And I think that's, well, I don't think that is what I have lined out right there. Got to 79, but this is not, dude, where's the space crew even? Like, what are they doing? Where, like, this, if it's over 89, I'm liking this a lot better. But again, as a trader, my job is just to identify where the moves are going to happen. And I'm not trying to snipe the lows and snipe the highs. So this is an interesting spot. But when something gets to my level, like I might have a level. So this is at a level. What I need to see is I need to see buyers step in. And where we are is because we're at a lot of levels for me, a lot of near-term levels. But I'm not seeing the buyers step in. And that is not what I want to see. Because that tells me that if this spot is not incentivizing people enough to jump in with strength for whatever reason, maybe albeit like geopolitical headwinds, I don't know, just shenanigans, like market sentiment. Well, it would need to go lower to get people more incentivized. And at that point, that's 55s. But and that's literally all the way back. You'd be giving it all back. Well, I mean, it's not all of it, all relatively speaking.
What's the downside target on ASTS you see?
Like 55. 55, but that doesn't come into play until we're under like 73s. So here now, it's like we're at a spot where I can actually see some congestion happening. Ideally, I'd like to see, so like if we don't make new lows, then I think that we could get more bounces because both are happening. Both the sellers are decelerating. And at the same time, the buyers are overly cautious. And so that creates this kind of like tug of war where stocks sometimes go sideways. They run and then they rest. And a lot of these things look like they might be in a bit of a resting period. And that would be best case scenario.
Ondas,
didn't it?
Yeah.
did.
Once the market turned, this one really turned. Also, there was a press release today.
Was it? Okay. So this is the higher beta one. So like it's right into this support, the center line middle area. I'm just going to move this into a basic.
They had a German state police contract today.
Yeah. So this holding over 9s is better. The thing is, it's better for right this moment. If you can get a higher low and we see people step in again, I can see that push into 12s, which becomes a tradable range. But that's what this range 9 to 12 is where the range is. I can't say anything higher until we're over 12 if we get something like that. So this one is what I was saying, like I'd like to see on Rocket Lab, literally that. I took this. So we have, let me just not do my lines and let me just do an automated channel to see if we're out. So it's poking its head out just slightly. Yeah, so this stays the same. Like if this can hold 9s, that's good. You lose 9s, then it's in the 6s. And I would be really, really cautious about this one because we are so. Let me check one thing on this. This is a more interesting chart, not gonna lie. Definitely more interesting. Yeah, so 1150. So this 12 would be normal, but a muted bounce would take you to 1150, which if that's all this gets, and then it stops, and then you get a little fade, that's what I don't want to see.
No. I mean, again, you're right. A lot of these trend lines are just down. And to your question, why aren't the buyers stepping in?
Where are the buyers?
I think everyone's scared. Now, I looked at some charts this morning. Retail has been buying the dip aggressively, but you kind of need the big guys to help push this.
That reminds me, do you guys still look at this National Association of Active Investment Managers?
No.
So a lot of people look at things like Fear and Greed Index or the VIX or things like that, or sentiment surveys, sentiment surveys, consumer sentiment, whatever, things like that. This is not a survey. So this is not your opinion. This is actually the money that's in the market. It's just NAAIM.org. Anybody that's somewhat OG would have an idea of what this is, but it's measuring essentially like actual exposure in the market. And so we're coming off of like 92s in January, pretty high exposure. Then we come down to 84. Now we're at, this is a weekly number, 80, spot 61. We tend to bottom out in the low 60s on this metric. So this is the S&P where we are. This is the exposure of actual funds. So it's not a sentiment gauge. It's something that you can reference that would probably be a little bit more reliable than some of those survey metrics. I think it's worth looking at. But if I see low 60s, then that's typically a decent spot.
Okay.
Yeah. So the website, you guys, it's a NAAIM.org. National Association of Active Investment Managers.
Would you want the Band-Aid to just be ripped off?
Oh, dude, I so want the Band-Aid just to get ripped off. Cause like, I'm so bored. Like, I'm so done. Like, just stop with the bleeding.